Good evening, everyone, and welcome to Admiral Markets webinar of 17th of September 2014. My name is Nenad, and today we will talk a little bit about which type of divergence to trade. I will show you 4 basic types of divergence, then 1 new type of divergence, and will show you how actually to trade and which type of divergence to trade. So before we begin, our standard is disclaimer. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration the information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author. It's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not a .co.uk website, but the globalnews.com website. Forex is a risky business, and this is a personal opinion only, and this webinar is informational and educational purposes only. So with having said that, we are ready to proceed. So what is divergence? Why divergence is important? Different types of divergence, how to trade it, and which divergence to trade. So what is divergence? Divergence is when an indicator and price action are being in disagreement. Let's say, for example, that the price is making higher highs or just one higher high, while at the same time oscillator, which can be MACD, CCI, stochastic, it is making a lower low. So basically that is when an indicator and price action are in disagreement. Usually it is when price and an oscillator, relevant indicators such as MACD, are moving in opposite directions. MACD is my standard tool for using and spotting the divergence, but there are a lot more things to be considered when you want to trade divergence. I also want to say that in November I will schedule a webinar about stochastic, moving average, and trend line divergence. So pay attention when that webinar comes out. This is just an intro to that webinar, and the webinar will be scheduled in November. So I will talk about using stochastic, using moving averages, not MACD but moving averages, and trend line for these types of divergence, especially reverse or exaggerated divergence, which we will talk about also today. So pay attention to the webinar, which will be held in November. So divergence is also an indication of a reversal or a continuation. Usually we trade divergence as a reversal, but sometimes we can also treat it as continuation. So those are 2 types of divergence. So either you will go in opposite direction, you will take trades in opposite direction, or eventually you will take trades which are basically in the same direction. So you just don't know what will show up. So if I will show you step by step. So let's go. Why divergence is important? It's an earliest indication of reversal. It's also a good sign to exit a position. It's a good sign to scale into a position. So you can go with exit, you can go to scale in. Usually when you have hidden divergence, which is type of continuation, you can scale into a position, so add in. If you are long and there is hidden bullish divergence, you can scale in. If you are long and there is a regular bearish divergence, so you can exit a position. So divergence can also be used, as we can see, for entries and for exits. It means that you're usually buying near the bottom or selling near the top. This makes the risk on your trades very small relative to your potential reward. Okay, those risks are very small and relative to your potential reward. So with having said that, we can move on. So different types of divergence, which are important divergence and which are different types of that divergence. So we have regular bullish divergence, hidden bullish divergence, regular bearish divergence, hidden bearish divergence, and reverse or exaggerated divergence. You probably never heard of reverse or exaggerated divergence because not many people know about it. And I will explain what this is. Usually we use regular hidden, but reverse exaggerated, it's something new, right? So regular divergence. Regular divergence, it doesn't matter whether there is a regular or a hidden. We are now talking about regular, so it can be regular bullish and regular bearish. It's also considered a sign of trend reversal. So if you are long and you can see that the price is making basically a setup for regular bearish divergence, you can exit a position. If you are short and price and indicator are set up for making a regular bullish divergence, then there is a higher probability for the price to jump up, so you exit the position, okay? So the divergence also tells you when to exit, not just when to enter a position. It also tells you when to exit. The thing is, if price is making lower lows, but the oscillator is making higher lows, this is considered to be regular bullish divergence. We don't need a series of lower lows. We need just one low to be lower than the previous low. So we don't need a series of lower lows. Only one low is needed to be lower than the previous low. So it can be found near the bottoms. So this is it. Price is making lower low, so this is the first lower low, while at the same time the indicator, let's say in this case MACD, but again, for all of you who joined later in November, I will be making a special webinar how to actually trade divergence with stochastic and with moving averages and trend lines. Now we are talking particularly about MACD. So this is price action. So price is making a lower low. Indicator is making a higher low. So as you can see, price action and indicator are in disagreement. So lower low, higher low. So that is a regular bullish divergence. The price will and usually will indeed jump up from the support when it's made. We have hidden bullish divergence, usually a trend following type of divergence. Hidden bullish divergence happens when price is making a higher low, but the oscillator is showing a lower low. This can be seen when pair is an uptrend, and hidden bullish divergence will tell you that the chart will go up. So this is hidden bullish divergence. So price is making higher low, but at the same time, the indicator has made a lower low. In this case, the price will go up. So this is hidden bullish divergence. Regular bearish divergence. Regular bearish divergence is usually the most frequent one, and it's usually considered a sign of trend reversal. So if the price is making a higher high, but the oscillator is making a lower high, then you have a regular bearish divergence. And it can be found near the tops. Okay? So regular bearish divergence is usually showing up near the tops, and it's usually a sign of retracement or reversal. So the price is made a higher high. Look at this. But the oscillator at the same time has made a lower high. That is regular bearish divergence, and the chart is going to be sold. Hidden bearish divergence is usually trend following type of divergence. Hidden bearish divergence happens when price is making a lower high, but the oscillator is making a higher high. And usually hidden bearish divergence, it happens during downtrend, and that hints to the chart continuing to go down. So divergence is basically telling you, hidden divergence is telling you that the chart will continue in the trend direction. Which indicator is good for finding divergence? A question. I personally use MACD. For me, it's the best. But also I have learned to use stochastic and trend line and moving average. That is what I will show you in November. But also you can use CCI, you can use on-balance volume, you can use momentum. So any type of oscillator you can use for divergence. My personal favorite is, of course, MACD. Chris uses, I think, awesome oscillator. I use MACD, but basically those are pretty similar. But MACD, I really prefer MACD. Standard values, yes, Claudio, 12, 26, 9. So those are standard values for MACD, 12, 26, 9. Okay? And this is hidden bearish divergence. So price is making a lower high, but at the same time indicator is making a higher high. So lower high and a higher high. Reverse divergence is that special divergence, and it's a little bit different than regular and hidden. Reverse or exaggerated divergence usually is found at the top or at the bottom. Bearish exaggerated or reverse bearish divergence is found at the top of a larger move, while exaggerated or reverse bullish divergence can be found at the bottom of larger move. It is similar to regular divergence. The difference between these two divergences is exaggerated divergence price creates double tops or bottoms or similar highs and lows, but the oscillator will not make same double top or bottom. So the only difference is, look, we can see a similar high or double top, but the thing is the indicator will not show that. So second price high should appear double top. So this is the first high, and then there is a similar high. It don't have to be very, very, very similar to this. It can be a little bit below or a little bit above. But it's basically like when I say double top, it's usually treated as double top here or there. It doesn't matter. It does not to be perfect. So if the second price high is double topish, and at the same time the indicator is substantially lower than the price high, that is basically exaggerated bearish divergence. I will give you a brief time to look at this chart because you won't be seeing this very too often. Take a look, pause your screen and print this to know that when you see this, that this is exaggerated or reverse bearish divergence, and then we can continue to move on. Okay. Now, exaggerated bullish divergence. You can see we have a similar situation, but now we have double bottom. As in the previous slide, second price low. So this is the first price low, and this is the second price low. If we see double bottom, and the price indeed appear double bottomish, what will happen is the indicator will probably, the second low will be higher than the first low, and then you know that there is exaggerated bullish divergence. Once more, price action, we have one low, then second low, but second low looks like a double bottom. It does not have to be perfect. In the same time, indicator is making a higher low compared to previous low, substantially higher. So guys, that is exaggerated bullish or reverse bullish divergence. Take a look. I will pause the screen for a brief moment and I will give you some time to take a look and print screen, because you also won't be seeing this very often. Okay, now this how to trade divergence. Now I will actually show how to trade divergence with few very interesting methods. And again, now I will use MACD. I won't be using other tools, only MACD. But the thing is, again, for all of you who joined up later, I will be making a webinar in November showing you how to trade divergence with moving averages, stochastics, and trend lines. Now we are talking about trading it with MACD. So, how should we trade divergence? So we need to spot the divergence on the candle close. Always, guys, at the candle close. Not while the candle is leaving, because if you go with leaving candle, you don't know whether that will be divergence or not. MACD divergence works excellent. You can also use RSI, you can use CCI, stochastics, OBV, momentum, rock, whatever. I personally use MACD indicator. Chris, as I know, use awesome oscillator. Draw a trend line and or wait for break or MACD cross if no wonder contra divergence can be spotted. So if you saw, let's say that you spotted a hidden bullish divergence or regular bullish divergence, and in the meantime, while the rules for the next trade are not yet meant, in the meantime there is no other divergence in opposite direction, you can trade it. Use MACD 2-line, modern MACD. So this is regular bearish divergence, you can see. Regular bullish divergence. The price has made a lower low, but in the same time the oscillator has made a higher low, below the price, below. So look at this, trend line below the price. So the first rule is you can trade it by the break of trend line, and the second rule is you can wait for MACD. Usually you pick one or the second. Sometimes this cross, blue above red, will be much faster than trend line break. But it's up to you. You can use this or this. So you can use either MACD blue red line cross or trend line cross by price. In this example, we can see that the cross of MACD has happened here, but it was supported at the same time with the breakout of this trend line. So you can see regular bullish divergence hints to the chart going in opposite direction. So we saw a downtrend. This is the swing. So first swing, second swing, third swing, and at the fourth swing, price has indeed broken trend line and probably went up afterwards. Hidden bullish divergence, as you know, is giving us the cues that the price will continue to move up. You can see it here. We have hidden bullish divergence. Price has made a higher low, but at the same time the oscillator has made a lower low. In this example, we can see that the break of trend line was a little bit faster than MACD blue-red crossover. So in this point, there was a blue and red crossover, but the breakout and confirmation of hidden bullish divergence happened at the break of trend line. We have uptrend, first swing, second swing, and at the third swing there was hidden bullish divergence, which is giving us the cue that is that the price will go up. Okay? A regular bearish divergence. You can see the power of tops and bottoms when you use regular divergence. Look at this, regular bearish divergence. We have basically uptrend. This is the first swing, this is the second swing, and at the third swing the price has made top, and you can see the divergence here. Now trend line has been made. Break of this trend line again is much faster than MACD cross, which has happened 2 bars after. So you can either take a trend line break, or you can wait for a MACD cross to actually give you a confirmation of divergence trade. Hidden bearish divergence. The price is in a form of downtrend, but we want to see some sort of continuation. So this is the first swing to the downside, second swing, third swing, and at the fourth swing what happened basically? The price has made a lower high, but the oscillator has made a higher high. So that means that the price will go down after a confirmation. So in this example we can see a confirmation of trend line break, but there was a drawdown, and at the MACD cross it happened. So you can see that sometimes trend line will give you faster entries, but then again MACD blue-red cross will give you later entries, but probably more secure. How to open a trade based on divergence? Fool Rajib is asking. Well, I told you, you need to make a trend line in this example, let's say, and once the price breaks through this trend line, you trade. Or you can take the trade here at blue-red cross on the MACD. These are all examples of how you can open a trade, a fool. Look, trend line in here. Or wait for MACD cross there. Trend lines will be usually faster because its MACD is lagging indicator. It captures the trend perfectly, but it's lagging. So you can see the break of trend line or the MACD blue-red cross. I will go through these slides again, guys, just for you. I will give you 10 seconds for each slide to basically memorize it on your computer, and then you can use it after I finish with the webinar. So you will know when to enter divergence. Okay, let's go with the first slide. I think this is the first slide. So just save it to your desktop. Then second slide. Third slide. Fourth slide. And now exaggerated divergence. You can see that the price in this example has made this is what we were talking about, double bottom. But at the same time, the oscillator, in this case MACD, has made a higher low. And look how the price behaved. At the break of trend line, which happened basically at the same time as MACD blue-red cross here, after this vertical line. Now we see a reverse or exaggerated bearish divergence. We have a double top, but we also have a slight lower high. And you can see M pattern here. This is M, bearish pattern. But here in this point, you could have taken divergence trade because you can see blue-red cross has happened here, where my arrow is showing up. So, what types, guys, of divergence to trade? Hidden for trend trades, regular for counter trend trades, and reverse divergence for counter trend trades. Okay? Remember this. There is no exception to this rule. Hidden for trend trades, regular for counter trend trades, reverse for counter trade. Again, always spot the divergence of candle close. MACD will work excellent. You need to draw a trend line or wait for a break or MACD cross and use MACD 2 line. Now, comment sticks are strange. Yes, this is basically just an example of exaggerated bullish divergence. This is not MetaTrader 4, but this can be spotted on MetaTrader 4, but you need to search for it, because exaggerated divergences are not so common, okay? So, as I told you, there are also ways to trade divergence with MAs and stochastic. It is a different method and will be covered in November. Just for your now you can, if you have any questions, you can ask me basically, and I will gladly answer you. In this example, we can see the first is hidden bullish divergence setup. On the second, number 2 is the regular bearish divergence, and the third and the number 3 is exaggerated bearish divergence setup. So you can basically see that all of these setups have happened on the same chart. So hidden bull, then regular bear, and exaggerated reverse bearish divergence. Yes, the question, Laszlo, do we see histograms and sometimes lines of MACD? Yes. The thing is, this is this is stochastic. But if you want to look at these, you don't look at lines. Lines are just for entries. Histograms are only for basically, okay, I didn't put it correctly. These lines are just showing you the tops and bottoms. Look at this, tops and bottoms. Okay? But at the same time, you use these lines for entries. I personally look histograms for MACD. Now I'm talking particularly about MACD. When I will be showing you stochastics, then you will be looking at the lines, because stochastics do not use histograms. MACD uses histograms. So for me, always is the best to use histograms and lines for making entries if you don't go with the trend line break. But my personal preference is to use histograms, and always use histograms for spotting divergence, but also use trend lines. They're a little bit better because they will give you an early entry for divergence, while MACD can be a little bit laggy for entry. But you can see that also MACD crosses after the divergence have been also successful. In this example, it was shown, but this is this example does not show lines. These are histograms. So you look at the histograms, and then at this point there was a cross. At this point there was a cross. And histograms also, look, at this point, I will mark this. This is a low, okay? This is a low. But at this point, there is a high. Now, Laszlo, look at this histogram. This is low, and this histogram is a high, okay? Do you understand now what I'm showing you? So always watch for histograms for drawing the divergence lines. And you can use these MACD lines, if you're trading MACD divergence, for spotting an entry. If you are clear with this, yeah, thank you. No problems. So yeah, Laszlo has basically given me a reminder to tell you this. So guys, always use histograms. Don't look at lines when you want to spot divergence. Always use histograms. Look, this is histogram. Sticks, this is histogram. Yeah, now Jonat is telling me I only have one line. That is because you don't have this MACD. This MACD is called MACD 2 line, or real MACD. Today we don't use one line MACD. That was an old MACD. So today we don't use that kind of MACD. Today we usually use MACD 2 line. And that is what I have been working with, MACD 2 line indicator. So you need to have this indicator for spotting divergence, not standard MACD which has been integrated in MT4 platform. It's not good. So you need to have a custom indicator. I was making a presentation about it. Yeah, if you are a real account user, I gave that indicator to real live account users of Admiral markets. So if you are trading with Admiral markets, you need to tell me, just tell me your name, account number, I will send you to line MACD by email. You know my email, tarantulafx@gmail.com. So I will send you that indicator because I already gave that indicator on my presentation. But if you cannot Google it, of course, I will send you. No problems with it. Okay, no problems. So that is a reminder. Regular bearish divergence has happened here. Look at histograms. Price has made a higher high, but at the same time, MACD has made a lower high. We have a trend line, and at this point, trend line has broken. This is the point of break for the trend line. Okay, this is trend line break. And this is MACD cross. Look, in both examples, the price went down. Okay, in both examples, the price went down. This is hidden bullish divergence. And you can see that we have a trend line here. The trend line has been broken in this point. And the price continued to go up. At this point, there was blue-red MACD cross. And the price went for a drawdown, but then it proceeded to go to the upside. This example, trend line here, this is the break of trend line, and this is one bar later was MACD blue-red cross. When you have a confluence of trend line break at the same time with MACD, there is double confirmation for you to take the trade. This is the example. You can see the double confirmation here and here at the same time. Mila is asking, how Divergence is working on lower time frames? I don't look on lower time frames. I don't look at 1 hour or lower than 1 hour. 1 hour is my preferred divergence type of setup. 1 hour chart, of course. But to be honest, you can. It doesn't work quite well on M5, M15. It will go for 5 pips, say 6, 7 pips, but it's not reliable. So it's best used on 1 hour and 4 hour charts. For, of course, intraday setups. So 1 hour and 4 hour charts are probably the best charts. For me, a 1 hour chart, but also 4 hour chart is good. Also need to tell you that today is FOMC statement. We need to be very careful. The news will come out in 1 hour and a half. There will be volatility in the market. And if you're not sure what you're doing, do not take any trades. If you're not sure. If you're sure what you're doing, then you can go with it. So, regular bullish, regular bearish, yeah. The question, do divergence, do they work just in trend or in sideways? Just in trend. Why? Because you have, now pay attention to this. Regular bullish, hidden bullish, regular bearish, hidden bearish. What we in reverse? What did I tell you about regular and hidden? When price is going up. Sorry, I will use these examples. Let's remind you about regular bullish and hidden bullish. It's the same for this, but in opposite direction. When you see regular bullish divergence, when do you see it? You will see it when the price is going basically to the downside. And then you see regular bullish divergence. So this was a trend, right? Lower lows, lower highs, lower lows. Zigzag, trend. Now the price has touched important support, trend line has been broken, bang, the price went down. So before reversal, jump up from the support, before that we had a downtrend. So that is a regular bullish divergence. So you need to have downtrend, not sideways. Sideways is range trading, and you don't trade divergence when market is going sideways, okay? You don't do that. So what you do is basically hidden bullish divergence. So the price is going up now, and you see hidden bullish divergence. That means that you can add to this position because the price will continue to go up. So again, we had uptrend prior to hidden bullish divergence. So before any divergence is happening, you need to have a downtrend for regular bullish, uptrend for hidden bullish. And reverse exaggerated divergence, again, my PPT has been frozen now. Let me pause the screen. I will reopen it. I will reopen. Sorry for this. This is not up to me, but sometimes it happens. Okay, let me open it again. Okay. This is it. So now you can see again my screen. So just for a showcase, look, hidden bullish. The price is in uptrend, swing, swing, swing. And then it continued to go up. For bearish, the price has gone upside, so we had a trend here, and then bang, it went down. So no sideways trading, only trend. This is trend. Low, high, lower low, higher high. You see, low, high, low, high, low, high, low, high. And then bang, trend line break. Okay? Now here, hidden bearish divergence. We have a trend, bearish trend. High, low, lower high, lower low, lower high, lower low. And then in this point, this is a lower high compared to this. So the price, you see, bang, bang, trend line, and it went down. Do you see the image, guys, of hidden bearish divergence here? Do you see the slide, hidden bearish divergence? Yes, okay, thank you. Which time is good? 1 hour is, for me, is the best, because I trade intraday. So you're welcome, Laszlo. I'm trading intraday, so for me, it's always the best to use a 1 hour time frame. Because if you use it to 4 hour, it works, you can see. But it's not intraday, it's more intra-week. Because this candle is 4 hour, this 4 hour, and you 1, 2, 3, 4, 5, 6 hours. That's basically 6 4-hour candles, that's a day. So usually 4-hour trades are intra-week trades. I usually do it on 1 hour charts because I want the price to trade each day. You can see from my on Forex Factory, you can see my real account trading profits, and you can see that I'm basically trading intraday, and I'm going it slowly, step by step. I'm not in a hurry, and that's another important thing. If you want to go slowly with Forex market and you know what you're doing, you will be successful. If you're rushing in a trade and you're very greedy for profits, then in a couple of months you will be a losing trader. And that is the truth about Forex market. Only 95%, only 5% of Forex traders are successful in Forex market. 95 of those are losers. And I'm not talking about being 1 month profitable. You need to be at least 6 months profitable to be considered a profitable trader. And I don't think that it's not good if you are 1 month you are 10% in profit, next month you are 50% in a loss, then again you had a luck, then you are in profit. No, not like that. You need to be consistent. Your equity curve is good if it goes like this, because this is a trend, both for winners and both for losers. If your equity curve goes like this, that's whipsaw. So you're not a good trader then. How is two-line MACD different for normal MACD? Two-line MACD uses basically 2 lines. One is a signal line and the other one is trend line for that. One is faster, the other one is slower. One is basically, this is faster, blue is faster, red is slower. Red is capturing the trend. That is a trend line, line for trend, because that red line is basically has captured the trend, and that line is a little bit laggy. This line is signal line, and when it breaks through red line, it gives you a signal. But those are different calculations. So this is the MACD which we use it today. We don't use one line MACD. So you need to have 2 MACDs. And divergence happens in between also those 2 MAs. Okay? So one is faster, the other one is slower. While normal MACD is having only 1 line. And I personally really never use that single line because When I started to trade, I was introduced to two-line MACD, and since then it has been the favorite indicator of mine. So guys, I hope everything is clear. If you have any further questions, you can ask me. If you don't have, I can assume that this webinar has been pretty understandable and clear. Pay attention, as I said, to this. There are ways to trade divergence with MAs and stochastics. I will show you this in November, so pay attention in November when this webinar happens. So for all of you who like to use stochastics and trend lines and moving averages, this will be the webinar for you. Special webinar, okay? So pay attention to it. Maybe it will be a premium webinar for all of you who are members of other markets, because we have a lot to talk about on this webinar. And I'm sure that you have never seen such things. So thank you for attending the webinar. Thank you for listening to me. I will be again with you soon. And oh, wrong slide. Okay. Another question. Let me. Okay, MACD. Yes. Which time frame is good to use? I already answered. 1 hour. Good. Yeah. Great. Great, guys. Thank you. Okay, no problem. I wish you all a great evening. Be wary for FOMC. And I will talk to you very, very soon. We had a good week, and we are still having a good week, but the market needs movement for us to be able to trade with it. We don't take, we are not buying the highs, and we are not selling the bottoms. We are waiting for retracement. Okay, so pay attention to FOMC. Thank you, and talk to you soon. Cheers.